Welcome back to segment 2 now of Unit 1 when we talk about acquiring and organizing management and information for your home farm business or agricultural business. Let's get to the farm business activities, and they can really, we can break these farm business activities or agribusiness activities into three sections or three segments in an accounting system, whether they're production activities, investment activities, or finally financing activities. So let's look at some production activities. Anything that's related to the production of crop and livestock goes as a production activity, whether we're talking about revenue or expenses. When we talk revenue, it's sale or government program payments, or maybe you go out and do some custom combining or planting operations. You can collect revenue in that regard, and that counts as a production activity in your accounting system. Your expenses, of course, are then feed, seed, fertilizer, all your inputs. But don't forget to include in that production activity interest, let's say an interest payment on a combine that you purchased, or depreciation as a deduction as that combine depreciates over time and loses value. Those are all production activities. Second is investment activities, whether we talk about related to the purchase, depreciation, or sale of long-term or long-lived assets like land, buildings, orchards, breeding livestock. Notice not market livestock, but breeding livestock. And it's important to make that distinction because as we go through here in the class, breeding livestock and market livestock are valued and counted very differently in many different record systems. So it's important, let's make that distinction and get that up front and remember that through the entire class. So things to keep with regard to investment activities and key records: purchase dates and prices, depreciation amounts calculated for different pieces of equipment or buildings, book value versus current market value of livestock or equipment, sale dates and prices, and gain and loss when you sell. Thirdly, then we can look at financing activities. So all transactions that relate to borrowing money, paying interest, and principal of debt on debt of all kinds. So we always need to know how much money we've borrowed, financing those new investments, whether it's operating money, mortgage payments, and accounts payable to suppliers. So what that means is if you have had seed delivered to the farm that haven't paid for it yet, and that invoice is coming, that is an account payable that you owe and will count on the balance sheet that we'll talk about in a subsequent unit here. So pay special attention because some of these expenses cut across more than one category in your accounting system. So interest expense is a financing activity, but also a production expense. And you need to know how to break those things out if you need to appropriately or where to expense it. Depreciation on an investment is a depreciable asset, but also a production expense. So you have to know in your accounting system, how does that work? The next couple slides are just basic accounting terms, whether it's account payable or account receivable, whether you owe somebody money or somebody owes you money. An accrued expense, so a daily accumulated expense that's not yet been paid, and the due date is sometime in the future. So for example, interest on loans typically due at the maturation date or property taxes. Assets are anything of tangible value or financial value that you have. So whether it's bank accounts would be the obvious one, but even grain that you have sitting in the bin at home, it's an asset. It has value that you could liquidate and utilize at any time. Credit, records decrease in value or increase in liability or an owner equity or an income account. A debit or an expense, so a cost expenditure incurred with the production of revenue. Inventory, we've talked about that, a physical quantity or financial value of products. A liability or debt or financial obligation that you have, so a bank loan or a pickup truck loan is a liability. Net farm income is revenue minus expense, so that profit. And we'll talk more about net farm income in much more detail later. And then owner equity, so the difference between business assets and business liabilities. We'll really hit into that one when we talk balance sheets. A prepaid expense, a really good opportunity to maybe capture some discount percentages that reduce your operating expense. So a payment made for a product or service in an accounting period before the one in which it will be actually used to produce the revenue. So you may pay for a fertilizer and chemical package that won't be applied until the next cropping year in the prior cropping year. So for example, maybe you have the opportunity to prepay your nitrogen in November, and you go ahead and make that transaction and pay for that nitrogen up front, which would be in the 2020 cropping year or accounting year, but you don't actually apply that nitrogen and utilize it until the 2021 cropping year. It's different how you expense that out depending on the accounting system that you're using. And then lastly, revenue. So any cash received or value received for products and services in an accounting period, whether it's cash or non-cash. So many of you have been through our accounting class, and you talk about choosing an option, choosing an accounting system. So, what accounting period should be used? Most farm businesses will just use a typical calendar year accounting period. Others will use what we call a fiscal year accounting period, should you choose something other than the typical calendar. And mostly it should be selected based upon when is the cycle of business activities kind of naturally start and naturally end. So for example, us at the college, our fiscal year begins July 1 as we start into a new academic year, kind of preparing for that in August, and then ends on June 30, where we have kind of wrapped up one single academic year. Yes, we're in the middle of the summer term, but for the most part, all expenses have been paid and revenue has been received for that summer term most of the time by July 1 or very close to it, and can be moved accordingly afterwards. Should it be in a cash or accrual system? A cash system is certainly easier. An accrual system maybe gives you a more accurate picture of your farm financial or agribusiness health. Should it be single entry or double entry? And we'll get into that more here in a second. Basic or complete. Some of this is just simple personal preference in terms of how you want to approach your farm business management or agribusiness management accounting system. Let's look at a few things. I mentioned the calendar year versus fiscal year and explain that, I think, fairly close. Farmers, again, most of the time are going to use just the typical calendar year approach. Agribusinesses oftentimes use a fiscal year approach, delineated somewhere where that cycle starts and ends. This slide talks about a single entry versus double entry accounting system. Single entry, very simple, and I would expect that many producers out there prefer this method of accounting at home on their home operations because it's much, much easier to use. One entry is made for an expense or receipt, very simple. Instead of a double entry where there's offsetting places for those receipts or expenses. So in a double entry, though, the advantages are it really gives you a much more accurate picture, keeps the accounts in balance a little bit more easily. And it's, when we talk about completing a financial statement, it's a lot easier to do whenever you have a double entry accounting system. Basic versus complete. Basic accounting is just simple cash in, cash out, expense in, expense out, revenue in, revenue out. A very basic system, and again, fits very nicely for those producers who just want to keep it as simple in their records as possible. A complete accounting system is probably going to involve you purchasing either a packaged accounting system or building yourself an Excel spreadsheet in order to itemize everything out. And that way you can do cash accounting for tax purposes or accrual accounting. You can do a lot of different things. You can track inventories, compute depreciation, so that everything is expensed appropriately. So how do you choose a system? Well, accounting knowledge of the user is number one, and you have to be comfortable with what you're going to utilize for financial analysis. I would advise you to guard against picking something that is too cumbersome for you to know and understand, and then therefore utilize, because you'll just not maintain it the way that you would like to, and therefore it will not be very useful. The size and complexity occasionally of the business and its financial activities, and then what type of information do you want to make decision-making, to approach your decision-making plan. So those things should help you know which type of accounting system you need to be employing. When you talk cash accounting, again, simple revenue, simple expenses. I'm not going to read the whole slide here. It's very basic. The drawbacks here is occasionally you have cash that comes in for that doesn't match when a product or service was produced. So for example, we may have produced grain in 2020, but not sold it till 2021. In a cash accounting system, that grain, that revenue doesn't come in until 2021. And in a cash accounting, it won't be counted until 2021. But all the expenses were paid probably in 2020. So it makes your profitability picture in the 2020 cropping year probably out of whack. But it also is very simple. So you have to really think about cash accounting. Is that a good approach for you in terms of your record keeping and analysis? Good advantages is it's very, very simple. Requires very little knowledge and training in accounting approaches, and very simple when we talk about computing income tax. Accrual accounting, like we said, requires much more time and effort, but it gives a much more accurate picture of the business performance. So it moves revenue to the appropriate year of its expense, regardless of when the cash is received. So back to that example, when we talk about selling 2020 grain and the following, let's say we sell it in January of 2021, that revenue actually would be moved back to 2020 for accounting purposes, just so that you can see that profitability picture. So all expenses and all revenues are credited to the appropriate year when you talk about basic accrual accounting. So it gives you a better picture of profitability or lack of profitability. It gives you a really good picture of a financial analysis and therefore hopefully more sound decision making. The disadvantages is it's more cumbersome and it requires some knowledge to obtain good information. Otherwise, bad information is probably going to lead to bad decisions. Here's a good example, and you'll have the opportunity to review this in the notes as well, but kind of gives you a cash versus accrual example when those things would be sold. And furthermore, this example right here. So on the left-hand columns, you'll see a cash accounting. We sold $50,000 worth of grain. Grain inventory increase not available, so just $50,000 in revenue, $25,000 in seed, chemical, and fuel expense. 50,000 minus 25,000 looks like a net farm profit of $25,000. If we did that in an accrual accounting system, we had $50,000 in grain sales. We also kept $50,000 of grain in the bin, so it has value. So that's $100,000 that we actually have in total revenue. We, for example, prepaid some expense, $8,000 for fertilizer. Again, that same $25,000 for seed, chemical, and fuel. And then also that drying fuel that maybe we had prepaid or carried over from the prior year. So $36,000 in expense. And so therefore, actually, if we look at from an accrual accounting perspective, our net farm profit was $64,000 in this particular example compared to a cash accounting view of $25,000. Well, one of those is going to look a whole lot better to a banker than the other. So, and it certainly shows a lot different picture of profitability. So either of those are accepted. Accrual is recommended, but cash is accepted with end of the year adjustments. And we'll be talking about this more in later sections. This next section talks about chart of accounts. And one thing that I'll mention here is before I show you is what a chart of accounts looks like is this will help you itemize things out so that you know what costs what in your budget or accounting system. I also suggest don't get it too cumbersome. Again, for those of us who are managing your own farm business or your agribusiness, get it complete, but yet easy enough that it is usable for you. So let's look at a chart of accounts. So this is an example. So we can look at income line items or expense line items, cash line items. So it gives you a whole chart of accounts on what might be an income or expense and the amount that is credited to that in each line item account. As you know, this isn't required for any agribusiness or farm business or any type of business, but it allows you to break things out and know what you have in certain accounts or line items, what it's worth, what its value is, inventory value, things of that nature. So it is kind of helpful to know where your value lies in the farm business. We're going to talk about balance sheets in a subsequent unit, but certainly from an accounting system, you can build that balance sheet. It gives you the financial condition of a farm or an agribusiness or any business at just one single point in time. The income statement then is a report of revenue and expenses over an accounting period. Two totally different informational items that tell you two totally different things. And depending upon the complexity of the system, an accounting package can churn out all kinds of other reports for you. So here's a whole bunch of them. Again, we talk about start at the top, production, investment, and financing activities feeding into your accounting system. And then off of that, just very basically, we could get a balance sheet and an income statement that we could then utilize for analysis or reporting to your financial lender. But you can also get into depreciation schedules, employee records, cash flow statements, income tax reports, owner equity, family living expenses, things of that nature. You can pull out all kinds of things from an accounting system. So that wraps up what we have to cover here in Unit 1, Introductory Unit in Ag Finance. Just basically scratching the surface on accounting. In fact, we won't get too much more into accounting throughout the course. We're going to move on to some other different things. Hopefully this helps you as we get into the assignments of Unit 1 and builds a good foundation for the semester. Thanks for tuning in.